Hey guys, it's Nick Poe, Chief Investment Officer here at Jennings & Associates. What's a pretty dreary Thursday afternoon here in Paducah. Want to come to you today, obviously, if you've turned on any news, any computer, any level of media today, you've seen the headline, which is that Ukraine was invaded by Russia. I think anytime there's some unrest like that, it creates a lot of anxiety throughout the world, and quite frankly for us personally. I know when I turned it on, and actually I saw it before I went to bed last night, I saw it and I was like, man, just what does this mean to me? What does this mean to my family? What does this mean to our clients? So we certainly understand the stress that comes with that. So I wanted to come today really just to share with you some of the things that we're seeing big picture, and probably most importantly, what can you do personally at a local level to help with this situation, to make sure that you feel like you have everything under control. I'll tell you, before I even got fully logged in this morning, once I did get logged in, I had 67 emails from investment companies throughout the world telling me how they had the next best thing, anything to handle what was going on. So I know the noise is loud right now, guys, and we're certainly not trying to add to the noise. Just really want to help cut through the noise and really understand what we think are the key tenets that's going on, and really what you can do. I think that to start really is probably the taglines you're hearing on the TV, because I think a lot of times just hearing these words and not even fully understand what they mean just adds to the anxiety. Throughout the end of 2021, the word that was most popular Google search word was inflation. Now, inflation, I think most people fully understand, just when prices elevate up, and the concern is, will my money support the new prices of things come in? A lot of speculation on what's creating the inflation. Is it supply chain issues? Is it due to the monetary? Is there just too much money in the system? And we won't debate those things here today. But inflation is relevant. It's something we can measure, and we can see that inflation is quite frankly really high. What that led to is, once inflation was identified, the next tag word that you undoubtedly heard was interest rates. Talked about interest rate movements coming. Interest rates are going to go up. And I think a lot of people, is that a good thing or a bad? Well, I think it depends on which end of are you a buyer, are you a seller, are you a saver, are you trying to buy a house, those type of things. But it does appear that interest rates are going to go up. Those things can obviously change, but based on the inflation levels, it seems like that's probably something that you need to be aware of. But I think the thing I want to talk about today is a new word that you're going to hear. You may have started hearing it a little bit. It's starting to get on the Google searches. So I know it's starting to make its way out there. That's something that we've been following since about November, December, and that's stagflation. So stagflation is a phenomenon that's only happened once in the history of the United States. It happened in the 70s. And what that is inflation's high, unemployment's high, which we both have those things going on right now. But the kicker is GDP lowers, which means the economy lessens, weakens over time. And those things make it very difficult for the central banks to manage. So the traditional tool set they would use maybe to help with inflation, mostly being interest rates, start being a little harder to accomplish when you have a lower economy. So, it's going to be, quite frankly, a bumpy ride, we think, as the central banks work through this. We think they'll probably make moves, possibly make too aggressive moves, have to come back, make moves again, come back. So, we're expecting what in the world we live in we call volatility. Volatility simply just means change. Change can be a good thing and bad. What does it mean to you specifically? Well, probably not a whole lot, because quite frankly, you can't manage that. You can't control what the central bank does. I'm not even sure the central bank can control what the central bank does half the time. But what you can control at a household level is what I'd like to focus on in the next couple of minutes, to make sure that you understand, where you can pull levers and where you can't, and hopefully help alleviate some of the stress or give you some action items should you think change needs to happen. The biggest thing I think to understand is from an investment standpoint is the traditional way of investing. We've been saying this for years. I think we're at the definitive crossroad of it being true, is that the traditional method of stocks and bonds, quite frankly, is just a little antiquated and won't do that. Won't be as successful. A lot of reasons why. Again, we won't go into the details of that. But you need to know at a tactical level, interest rate movements are going to impact bonds heavily. So if you have bond exposure, if you have outside holdings that are in bonds or bond funds, I think that's something you need to be paying particular attention to over the coming days, weeks, and months. and probably years for that matter. But if you don't understand your interest rate risk, I think that's something you need to be considering. The advisors here were well equipped to handle that, to kind of do analysis, do some risk assessments, and make sure, let you know where you are in that. But really, I think the most relevant thing you can do as investors, particularly investors with a GPS investment strategy, is understand your income needs. For us, you guys know this, a core tenet to our investment strategy is everything's about monthly income. And our buckets are designed to support that. So bucket one, you guys know we often call the spend bucket. Spend bucket, it was designed to hold years worth of income that no matter what's happening in buckets 2 and 3, your income can be relied on for those couple of years. Because we expect these events to happen. We're prepared for them, we know they'll happen, they've always happened, they always will happen. Where people have always been hung out to dry is they've never had an adequate bucket one set up. We often talk about emojis. I don't know if you guys ever seen this, but we talk about the emojis or the emotions of our buckets. The great thing about our buckets is you're going to feel an emotion for each bucket no matter what the stock market's doing. The bad thing is you're going to have an emotion for each bucket no matter what the market's doing. In 2021, bucket 3 was a rock star. It had double-digit returns, and a lot of our clients were like, well, yes, we want that. We want those big returns. Why do we have buckets 1 and 2? Well, in market conditions like we've had really in the last month and a half is buckets 1 and 2 are really the more preferable buckets to have, and people are questioning why are markets going down? What's going on in bucket 3? But that's by design. That's the intent of having the buckets. They're doing exactly what they're intended to do over time. So, we understand the euphoria that we felt in 2021 in bucket 3 is probably providing the most anxiety year to date in 2022. But that's expected, and quite frankly, that's what they're intended to do. So with that, understanding your income needs and relaying those to your financial advisor is hugely important for bucket 1. We just want to make sure we have an adequate amount in reserve. So if you've drifted with your income spending habits, right now is probably a time just to look and say, do we need to tighten up? Do we not? What's that look like? And then relay that information to your advisor to make sure your bucket 1's aligned to the income needs you have, to make sure we have an adequate bucket 1 for you. Bucket 2 is doing what it needs to do. That's where we use options-based funds and ETFs largely. We have some other tools we may use in your accounts as well, but largely those are the sources we use. And those provide a floor and ceiling of range of outcomes for you. And then we have bucket 3, which is, the broad market indexes and really blue chip quality stocks, but they're going to go up and down largely. They're going to have much more large fluctuations. But like I said, in 2021 provided all the opportunity. But we do understand right now they're providing you guys a lot of anxiety, but we think they're necessary to hold all 3 buckets. At a tactical level, some of the things I think you need to be aware of with the buckets is we have an investment committee. I think most of you know that. We meet at least quarterly, unless I feel like they need to be more often, than we may call an impromptu meeting, which we've done quite frankly over the last couple months. But, we bring in third-party resources. We bring in people who we think are a lot smarter than us here in Paducah, Kentucky, and they do a third-party vet of our, the names we're using, the strategy, and they provide feedback, some of which we love to hear, some of which we don't. But regardless, we think having third-party feedback is great, and they provide us some tools and resources to assess. With that, in September, we made the first big move in anticipation of the market conditions we anticipated coming based on our outlooks, and that was we reduced interest rate risk in bucket 2. So you may recall getting some trade confirmations in bucket 2, and that was simply we just eliminated all the interest rate risk that remained in bucket 2. Here in January, we actually made another trade which we eliminated the rest of the interest rate risk or reduced investment interest rate risk in bucket 1, and we added what are called inflation protected securities. Inflation protected securities have the reverse relationship where they actually are favorable as inflation goes up, and if rates start coming down, they should be more favorable for that. And then lastly, in bucket 3, we have always felt confident in those names. Again, those are broad market exposure and blue chip companies with large cash reserves, and we think that's important in these market conditions. The most important thing of the buckets though is how we use those. So it's not that we just buy them and hold them and hope forever. No, in September, we trimmed some gains from bucket 3 to bucket 1. A lot of you didn't like that. We knew 2021 was such a strong year. Why are we taking money from bucket 3 to bucket 1? Well, we want to have dry powder. We did it again in January. So we trimmed again. We took some more of the dry powder, some of the gains off the table that you had in buckets 3 and 2. We spread them out more into bucket 1. Why we did that is for this moment right now. So bucket 1 has been a little bit heavy the last couple months, and that's been by design because we had such a favorable 2021. But we are actually reversing that. So as of this week, we've actually started deploying back from bucket 1 to bucket 3. Which I think is the most prudent investment strategy anybody can have. I know emotionally it's very difficult. When we see these conditions, we often think, man, do we need to go to cash? Do we need to sell out? How do we protect ourselves? Well, you've been protecting yourself all along if you've been in the GPS strategy. We've been trimming gains from buckets 3 and 2 to have as dry powder in addition to your income to deploy in these moments. So as of this week, we started incrementally deploying into bucket 3. That will continue if the markets continue to downslide. If they don't downslide, we'll kind of just sit in that neutral with that and then just kind of wait for the market conditions to show themselves at that time. But right now, we think that's a huge opportunity for our clients is that we trim gains and now we're deploying those back into the markets as prices come down. Because we know emotionally, we don't always want to do that. But I think overall, we're very happy with your strategy. We're very happy, but it doesn't mean we sit on our laurels. We're always evaluating. We're always bringing in those third parties to help us assess it, to make sure we're not missing something. We don't have any blind spots ourselves. But in the meantime, I think the best thing you can do is just be evaluating your household, communicating with your advisors. Your advisors are going to be communicating with you certainly during these times, but you don't always have to wait for them to reach out to you, even though I know they reach out to you quite often. But you can reach out to them and just say, hey, we want to come in, visit, and make sure our income, we want to tighten it up, or we think we're going to need more income based on these conditions. But I think always viewing it through those levels of communication are healthy for you and your advisor. We hope this helps. If you have any questions, don't ever hesitate to reach out to us. We look forward to seeing you in the office. I'm sure we'll be getting you drug in the next couple of days and weeks and months as it is. But if you have any questions in the meantime, reach out to us. We'll talk soon. Thank you, guys.